To Peter.
Hello and welcome to Kreston Reeves' webinar on financial reporting developments. Let's just take us through the agenda then, see the points that we want to cover. We're going to be looking at the Accounting Standard Financial Reporting Standard 102 and its developments. We'll see how that fits within the accounting standards and what options reporting entities have, and also look at the development of that accounting standard and its implementation. We'll also look at the future of the accounting standard as well, because it is subject to a triennial review. The next one coming up will be 2022. And we'll look at what might influence that future review as well. Then we'll have a look at some non-financial information reporting requirements that have recently been released. You'll see this is on gender pay gap, payment practices, and the publication of your tax strategy. And then we consider narrative reporting. Now, narrative reporting has long been a requirement of annual reports of companies in the form of a director's report, but more recently a requirement for a strategic report as well. But there is a more recent twist in the towel which perhaps places more importance on narrative reporting. Then we'll look at the filing options at Companies House for small companies. So they have the option of filing abridged accounts and what are now being called filleted accounts. So that's a look at the agenda then. So let's get into Financial Reporting Standard 102 and its developments. So here in the UK then, the Financial Reporting Council, the FRC, they're responsible for setting UK accounting standards. And you see on the screen there that so far they've issued 6 accounting standards. So we have FRS 100, which is the application of financial reporting requirements. Now, what FRS 100 does, it sets out the overall framework for financial reporting in the UK. So it explains which standards apply to which type of entity. Then we have FRS 101, which is the reduced disclosure framework. Now, this relates to groups only. So it allows UK subsidiaries that adopt international financial reporting standards in their individual statements to produce reduced disclosures. The thinking being that within the group consolidated accounts, the full IFRS disclosures will be incorporated. So that's quite a limited application to group situations. FRS 102, the financial reporting standard applicable in the UK. So that is a single financial reporting standard that applies to entities that are not applying international financial reporting standards, FRS 101 or FRS 105. So really that applies to the majority of companies and reporting entities here in the UK. Then we have FRS 103. This is a specific accounting standard for insurance contracts. It applies to any entity issuing insurance contracts or holding reinsurance contracts, so very specific accounting standard. And then we have FRS 104 on interim financial reporting. So most UK companies do not report on an interim basis. So this doesn't apply to most companies. But those that do, then this is the accounting standard to look to when you're reporting on an interim basis. And then finally, we have FRS 105, which is the financial reporting standard applicable to micro entities. So the very smallest of entities, they have their own specific accounting standard. It's based on FRS 102, but applies to the smallest entities and is quite specific in its requirements. So then we have a table on the screen then, which shows the accounting standard options. So you see that micro entities have the most flexible options available to them. In contrast, listed companies are required to apply international financial reporting standards. But we'll come back to that table a little bit later on in the presentation. So you see from that table that your options are really driven by the size of the reporting entity. So here we have in the table the qualifications for a micro or small company. So a company qualifies for being either micro or small if it does not exceed 2 of these 3 criteria, being the turnover, balance sheet total, and employees. So what's called under company legislation a small company can in fact be quite a large company. So take a company that has, say, a turnover of £100 million, but its balance sheet total is just 5 million and it has 30 employees, then it will qualify potentially as a small company. However, there are certain companies that are excluded from either being micro or small. And we have them here listed on the screen. They include things like, as you would expect, perhaps insurance companies or banking companies. So regardless of size, these kind of companies cannot be classified as micro or small and cannot apply the accounting options and exemptions for micro or small companies. If you're in a group, you also have to consider the group situation as well. So if a group contains any of these particular entities, then the whole group is tainted and companies can't qualify if they're within a group that contains these kinds of entities. So back to that table then. So if we look at micro entities, then they can apply the full FRS 102. They can apply Section 1A. Now that's a subsection of the Accounting Standard 102 that applies to small companies. As micro entities, they can of course apply their own specific accounting standard, FRS 105. And if you're absolutely mad, you could apply the whole framework of the International Financial Reporting Standards as well. We see for small entities, they've got a smaller group of options available open to them. They can apply the full weight of FRS 102, or they can apply just Section 1A, which has been developed for small entities. And if you're not a small entity, then you have to apply FRS 102. If you're in a group, you can apply FRS 101, or you could adopt the International Financial Reporting Standards. And we see there on the far right, listed entities, they have to apply the full weight of International Financial Reporting Standards, the IFRSs. So they're the accounting standard options then, depending on what type of entity you qualify to be. But let's now concentrate on FRS 102, as this is where most companies have to apply. So FRS 102 then, that came into force with effect from the 1st of January 2015. So let's take as an example then a December year end. So the first year end that it would apply would have been 31st of December 2015. So a company now with a December year end would have prepared by now two sets of accounts under FRS 102, December 2015 and December 2016. So for these kind of companies, they should be well familiar with the accounting standard FRS 102 and how it's affected them. Unless, of course, you were a small company, because for small companies that qualified, FRS 102 was delayed for an extra year. And that's why this Section 1A was developed within FRS 102. It was written specifically for small companies. And that applied from the 1st of January 2016. So again, taking as an example December year ends, just the December 2016 accounts would have been prepared by now under FRS 102, Section 1A. If we move throughout the year, take a small company with a November year end, well, its first accounting period will fall within the scope of FRS 102, Section 1A, for the year ended 30th November 2017. So a small company with a November year end probably hasn't prepared the first full accounts under FRS 102, Section 1A. So we see really the way it's worked out that FRS 102 has had quite a long implementation period, depending on the size criteria of the reporting entity and its year end as well. So as I say, FRS 102 was first published in 2013, being effective for accounting periods from the 1st of January 2015. When it was introduced, we were told that it would be under a 3-year review cycle. So how has that worked out in practice? Well, perhaps not surprisingly, the first triennial review has been delayed by a year. So it wasn't until March 2017 that an exposure draft, affectionately known as FRED 67, was issued, and this has a possible implementation date of December 2017. And here we are in December and it hasn't been implemented yet. So a slight delay to that process, as we see. So as I say, FRS 102 was first published in 2013, and we were on this 3-yearly cycle of reviews. But what have we seen in practice? Well, as you see on the screen there, there's been a number of amendments within that 3-yearly cycle. So in July 2014, we had an amendment regarding financial instruments and hedge accounting. In August 2014, the whole standard was republished. In September 2014, we had an editorial amendment. In February 2015, a further amendment regarding pension obligations. July 2015, this was the big one, taking into account the implementation of the EU accounting directive regarding small companies. So this was the introduction of the section 1A for small entities. September 2015, it was republished again. March 16, an amendment regarding fair value. December 2016, an amendment regarding notification of shareholders. And May 2017, quite a significant amendment for small entities, amendment regarding relief for directors' loans and their accounting. So whilst we were expecting a 3-yearly cycle of reviews, actually we've seen quite a bit of tinkering in that first period. So not quite the period of stability that we might have expected when this whole program commenced. So the first triennial review then, that's under consultation right at the moment then. What are the principal amendments proposed within that then? So we've identified the principal amendments in the table on your screen right now. The first one relates to investment properties where one company within a group rents a property to another group company. Under FRS 102 as originally drafted, this had rather peculiar accounting implications. So an investment property under FRS 102 has to be measured at fair value, with changes to fair value reported in the profit and loss account. So in this situation within a group, even though the property was used as for trading purposes for the group, at the entity level, the company holding the property had to account for it as an investment property, even though within the group consolidated accounts it was treated as a fixed asset, as a trading asset for the group, and was measured at cost. Well, that oddity is going to be removed, so that's a simplification that I think we would all welcome. The next one is regarding financial instruments. So FRS 102 classifies financial instruments as either basic or non-basic. And the definition will result in a simplified approach to financial instruments, with more being classified as basic, which requires more simple accounting and more simple disclosure. So that's again a simplification that is welcome. Quite a big change that was brought by FRS 102 was regarding the accounting of intangible assets, goodwill for example, on business combinations. And what FRS 102 required was that we analyse goodwill between the various components of intangible assets that made that up. And again, this is a simplification that's proposed, which will require fewer intangible assets to be recognised on a business combination. That's a step away from a complication that was introduced when FRS 102 first came into play. And the final proposal for amendments is regarding loans to small companies by directors or shareholders. And this is a relaxation requirement to discount long-term financing. And again, that's a welcome simplification for small companies. So it's expected that these proposed amendments will be implemented for accounting periods commencing January 2019, but early adoption will be permitted once the proposals have been finalised. So what are the future then? Well, I guess we would expect on the 3-yearly cycle, the next triennial review should be due in the year 2022. What's going to influence that review? Well, no doubt Brexit. A lot of the changes to accounting here in the UK is EU driven, so that's likely to change in the new relationship with the EU in the future. Also, what drives FRS 102 is the international financial reporting standards, particularly those developed for small and medium-sized enterprises, as well as the whole weight of IFRS itself and the direction of travel that those accounting standards take. That's what we can expect to influence future developments of FRS 102 and accounting here in the UK. In fact, quite a lot has happened with IFRS and hasn't been yet reflected in FRS 102. So these are the IFRS standards that have either been amended or in some way are not yet reflected within FRS 102. And perhaps the last two are the ones where we can expect some changes to FRS 102 in the future. That's around revenue recognition. That's quite fundamental, of course, in terms of reporting financial performance. Another very important one is how we account for leases as well. So thinking about operating leases then for a moment with an eye to the future then. Currently, we distinguish leases between operating, which are off balance sheet, and finance leases, which we bring on the balance sheet. So operating leases, these are ones where the risks and rewards of ownership are not recognised. And so we treat these leases as an expense. And so the asset and liability are not on the balance sheet, they're off balance sheet, as it were. In contrast to that, finance leases, this is where we recognise both the asset and the liability on the balance sheet. So very different accounting treatment depending on the distinction between operating or finance leases. Now, many people find this distinction somewhat confusing, and the result is that many assets that companies use in their trade are actually off balance sheet because they're treated as operating leases. And in terms of reporting in the annual accounts, there's very limited information on operating leases. So it's difficult then to compare companies, those that lease assets, against those that buy their assets. You could have two very similar companies, but a different treatment to their financing of assets, and their accounts and balance sheets can look very different, even though essentially they're doing the same thing. So in the world of international financial reporting standards then, IFRS 16 will require that most leases will appear on the balance sheet. There are exceptions for very short leases or leases with very low values. Now, what's the impact of that like to be? Well, it's estimated that around about 85% of leases currently do not appear on the balance sheet. So we're going to see the effect on listed companies as they apply IFRS 16 in the future. But we can expect this to influence perhaps the next triennial review of FRS 102, and it could well impact most UK companies and their financial reporting in the future. So that could fundamentally change the look of balance sheets as more and more leases are brought onto the balance sheet in the future. So quite a big potential change in the future when FRS 102 is next reviewed. Let's move on to a different topic then, reporting on non-financial information. The first one we've identified there is the gender pay gap reporting. So obviously a lot of news around gender pay. The BBC itself, for example, the way it pays its celebrities attracted a lot of attention. The BBC reporting on this topic quoted from UNESCO, which said that if the current rate of change continues, the economic gap between men and women will not close before the year 2133. So a long way to go before this gap is closed. How does the UK rank? Well, out of 145 countries, the BBC reported the UK ranked 18 out of 145. So the UK is beaten by Scandinavian countries, well, you probably wouldn't be surprised by that, but also by France and Germany, and perhaps more surprisingly, Rwanda, which appears number 6 in the ranking of 145 countries. So gender pay gap reporting then, who does this apply to? Well, this doesn't apply just to companies, but all UK employers with a headcount of 250 or more. And that headcount has to be taken on the 5th of April, so the close of the payroll, the tax accounting year end. So 250. What has to be reported then for these entities with 250 or more employees? Well, there are 6 specified calculations on gender pay gap that have to be reported. Also a statement of accuracy signed by a senior person within the organisation. And it's encouraged that there's some sort of narrative reporting as well, explaining the results and what action is being taken to close the gender pay gap that's been identified. When? Well, this applies from the 5th of April 2017 and is an annual reporting requirement. And you have 12 months in which to report on your gender pay gap. Where do you have to publish this information? Well, it needs to be published on your entity's website, and also there's a government website which collects all these reports as well. So we can have a look on that website and see how different entities are doing and what information they're reporting on gender pay gap. So as I mentioned, there's been a lot of publicity around the BBC itself. But let's pick up another one, Deloitte, the world famous accounting firm, Deloitte, and this is some of the highlights from their gender pay gap report that they've published. Now, as you would imagine, Deloitte take their responsibility very seriously. They actually produce a glossary report, which is about 8 pages long. And they do report an analysis and a narrative that goes with the hard numbers as well. Now, what's quite surprising for a professional firm, you see that the women's hourly rate as reported is 20% lower as measured by the mean average. That's quite surprising. So in their glossy report, Deloitte do go some way in explaining the gap that's reported here. And what they report is that the analysis of their gender gap pay figures tell us that our gender pay gap at 5th of April 2017 arises because women hold fewer senior positions within the firm than men. So while women make up 43% of the overall workforce, only 18% of the partners were female. And of course, the partners attract the highest levels of pay. So they say, adjusting these numbers, just their pay gap then drops to around 2.5%, which is much more reasonable and attractive. So you notice there, if you look at the quartile figures, that when we get into the lower quartiles, there's a much more even spread between men and women. Now, as we've seen with the BBC experience, of course, news organisations can pick up on these reports and perhaps report rather adversely. So it's good that if you can add some narrative explaining your side of the story and what action is being taken to close the gender pay gap in your organisation. Let's move on to another non-financial information reporting requirement then, and this is payment practices. So this is how companies treat their suppliers, how frequently they pay them, and how slow they are in paying. So this is another government initiative trying to encourage companies to pay more promptly in their supply chain. So a good thing to be encouraged. Who does it apply to? Well, this time it does apply to companies and also LLPs, depending on size. So exceeding 2 or more of turnover of £36 million or balance sheet total of £18 million or 250 employees. So it's going to pick up the larger entities, isn't it? What has to be reported? Well, it's payment practices and performance on what are called qualifying contracts. So it's not everything. You have to look at the definition of qualifying contracts. It is a bit surprising what is excluded from that. So that's quite an important definition to understand. When does it apply? Well, it applies to our accounting periods beginning on or after the 6th of April 2017. It applies every 6 months. And then you have to report within 30 days of that 6-month reporting period. So let's take, for example, a June year end. So the reporting periods will be the end of December and the end of June, if your financial year end is June. And the reporting deadline is 30 days after the end of the period. So that will be the end of January and the end of July. The first financial reporting period will be the year-end 30th of June 2018. So that means the first reporting period for a June year-end will be December 17, and the first reporting deadline early in the new year, the end of January 2018. So you can see some companies will be reporting very shortly on their payment practices. So where does it have to be published? Well, there's a government website where this information is collected and reported. Let's move on to the next one then that's been introduced, and this is publication of tax strategy. So we're kind of seeing a theme here, aren't we, of either business practices, social matters such as gender pay, or what's been used lately a lot is people's payment of tax, so your tax strategy. Who does this apply to? Well, companies, groups, partnerships, and surprisingly LLPs, because LLPs are transparent for tax purposes, but LLPs are caught by this information. Again, size criteria: if in the previous tax year you either had turnover exceeding 200 million or a balance sheet total of £2 billion. So again, it's the larger entities that are going to be caught by this reporting requirement. What has to be reported? Well, how you manage your tax risk, a description of the key roles and responsibilities for tax within the organisation, what systems and controls you have to manage the tax risk, and what oversight your board has on your tax strategy. Those are things that have to be reported. When? Well, this applies to financial periods commencing at rather odd date, the middle of September 2016. Again, it's going to be an annual requirement, and once you've reported your first report, then you have to publish your next one within 15 months of the last one being published. So take as an illustration, December year end, your first report has to be published by the end of this calendar year, the 31st December 2017. Where? Well, again, it's on your website that this information has to be published. Let's move on to our next topic then, and this is narrative reporting by limited companies. Now, it's always been a feature of reporting by limited companies that they have to balance their social responsibility. They obviously get the benefits of limited liability, and part of the contract with society is that certain information has to be published. So for a long time now, companies have to prepare a director's report. More recently, the strategic report has been required for certain companies, requiring slightly different information that's reported in the director's report. Now, the twist and tell here is the auditor's responsibility where those accounts are subject to audit. So for some time now, the auditors have to read the director's report, and if a strategic report is published, they have to read that as well to make sure that it's consistent with the information contained in the financial statements. And if it's not consistent, then the auditors were under a requirement to publish information regarding that inconsistency. So quite a low level of scrutiny, really. However, there is now an additional requirement on auditors for accounting periods beginning on or after 1st January 2016. And this is that auditors now have to consider whether the director's report and the strategic report had been prepared in accordance with the legal requirements that drive the reporting and disclosure requirements, together with any material misstatements that have been identified. But this is much more onerous requirement upon the auditors to effectively police what the directors are reporting in their report or the strategic report. So let's remind ourselves of the requirements. Then start off with the director's report. Now, over recent years, the requirements of the director's report, particularly for small companies, have been watered down quite significantly. And those that are micro entities and report under FRS 105, there is no requirement at all for a director's report to be published. So you see there the distinction between small companies and large and medium companies and the requirements. Picking out some of the more important ones perhaps, those companies that provide their directors with indemnities, even a small company has to provide details of that benefit in the director's report. If a company is subject to audit, there are statements required in the director's report that all relevant information has been provided to the auditors. So a reminder to the directors of the responsibility to inform the auditors of any important matters. And one that applies there even to small companies is companies that make political donations exceeding £2,000 in the financial reporting period. But we see that a lot of reporting requirements for the director's report apply only to large and medium-sized companies, as indicated by the ticks in the right-hand column. But those companies that employ 250 employees or more, even if they're small, they do have certain requirements to report on employee-related matters. So that's why you will see some directors' reports being a lot larger than other small companies with a small payroll. Moving on to the strategic report then, this is not required for small companies at all. So none of these requirements apply to small companies, but large and medium-sized companies have to report on these matters, including a fair review of the business, looking at the principal risks and uncertainties, a description of those, a description of the development and performance of the company in the period, and key performance indicators. Now, these kind of descriptions are quite loose, really, aren't they? And that's why many companies are quite weak in their strategic reporting. And that's why the auditors are now required to look at the strategic report and see if it's consistent with the legal requirements. So we should see perhaps improved reporting in these areas of both the director's report and the strategic report. So let's give an example then. This is a real life example taken from the company's house, a company called Simco. Now, probably not a company that you recognise. This is actually the vehicle that's used by Simon Cowell for his music production and also his TV assets, including the X Factor and the talent programs as well. So here we have a review of the business then, which picks out some of the key numbers, not particularly informative, but you see there's a bit of narrative talking about the fall and decline of the profit in the year, the reason for that, lower licensing income, and the reason giving the phasing of record releases. So you can see how that could affect reporting from one year to the next, depending on what records have been released in the reporting period. We then have a description of the risks and uncertainties. So that is not boilerplate wording that's used, that's wording that's been developed for the particular needs of this company. So that's good to see that reported in that way. Moving on to the key performance indicators, the KPIs. So the numbers there are not very specific really, talking about gross profit, for example. But then in the second paragraph, we get a more narrative description of the performance indicators, talking about television ratings. And obviously that's a key factor, isn't it, to the profitability of this particular company. So some quite interesting description there of the programs and the ratings they're attracting. Not much information about trends or the prior year figures as a comparison. But you can see how an attempt has been made, hasn't it, to give us some strategic information there regarding the company, specific to this company. So a good attempt by Simco there, I believe. So the company there, its turnover is around about 40 million. It has net assets of about 18 million. So not a huge company, but that's how the information has been supplied in the strategic report. Let's move on to our topic then about filing options in a company's house. But this applies to just small companies, so not medium or large companies, just small companies. So small companies can file their full accounts at the public record at Companies House, or they can choose abridged accounts, or what is now called bulleted accounts. So they have three options in terms of what information they report at Companies House that goes on the public records for their financial statements. Again, this is driven by the size criteria that we saw earlier in our discussion. Size, certain excluded types of entities cannot qualify as small companies. So again, the same measures we saw before: turnover, balance sheet totals, and employees. And the same categories of excluded companies that we mentioned earlier as well. Insurance companies and banking companies, those sorts of entities are excluded from being small companies. So if you are a small company that qualifies, then what is your option? As we said, you can supply to Companies House your full set of accounts, or you can elect to file abridged accounts. Abridged accounts then are simplified accounts. So the profit and loss account, the balance sheet are simplified. The profit and loss account excludes turnover, for example. It starts with the gross profit line. And the balance sheet is a somewhat simpler balance sheet with many of the headings compressed and the numbers accumulated. Now, with abridged accounts, that does require the consent of all the shareholders every year. And the reason for that is that the shareholders, the members of the company, will receive the abridged accounts as well. So the information the shareholders get is the information that goes from the public record. So of course the shareholders may want more information. They may want to see the full statutory accounts, in which case they will not give their permission. So we probably see abridged accounts as being no particular popular option, especially when we consider the other option that's available for small companies. And this is what is being termed as filled accounts. Now what happens with these accounts is that you take the full accounts and then you cut out certain bits that small companies aren't required to file at Companies House. So they can exclude the director's report. They can literally cut out of their full accounts filed at Companies House the profit and loss account. They can go through all the notes to the accounts and cut out all the notes that apply to the profit and loss account. So you can see why they're being called filled accounts, because you take the full accounts and then you cut out certain bits and file the remainder at Companies House. Now, because these accounts have certain bits cut out, if they are audited, you can't file the audit report because they wouldn't show a true and fair view because certain information has been cut out. But instead, a statement regarding the audit report has to be included with the filled accounts if they're filed at Companies House. So in summary then, what have we seen in our discussion so far then? Well, we've had a look at FRS 102, the accounting standard applies to most companies here in the UK. We've seen that it had a rather long implementation period, that it is subject to a 3-year review, but in that first period of review, there was quite a bit of tinkering that took place. And the next review that takes place will be in the year 2022 if we stick to the 3-year cycle. We've seen quite a lot of development about non-financial information that has to be collected and reported for certain entities. And you notice the timelines for the introduction of this. It's all been fairly recently, as far back as September 2016 and April 17. And it's really addressing information needs that society is asking about gender pay or payment practices of large organisations which have a bad press about paying small suppliers over a long period of time and slowly. And of course a lot of publicity around tax at the moment as well. And people are paying their fair share of tax. And now to reporting. Well, this extra requirement now for auditors to police the reporting or narrative reporting in accordance with applicable legal requirements. So we'll see a bit of tension potentially between what directors want to report and what the auditors think the law is asking directors to report. And then finally, filing options for small companies. We've spoken about they can file their full accounts. With shareholder consent, they can file abridged accounts. Or the most popular option that we're seeing is filing filled accounts, taking out information that's not required from the full set to the set that is published at Companies House. Now there is a balance to be struck here because obviously accounts are used by credit rating agencies, potential customers and suppliers. So if you're the kind of entity that relies upon your credit rating that you know that your customers examine your accounts, you may choose to file your full accounts, even if you're a small company, because it supplies the information that those entities will be looking at. So it really depends upon who you think your readers of your accounts are as to what should be filed at Companies House. So that's been our webinar. Thank you very much for listening.